Sam Zell watched the real estate market of the 1970s crumble, leaving thousands of investors in total ruin. But while others fled in panic, he was buying every building he could find for a fraction of its real value. They called him the grave dancer because his fortune was not built during boom times, but by feeding on the financial corpses of his most reckless competitors. If you think you need a stable economy to become wealthy, make sure you stay until the end, because we will reveal Sam's golden rule for identifying the exact moment when a dead market is about to come back to life and how you can apply it today. Let us go. The art of buying when there is blood in the streets. Sam Zell was not a conventional real estate investor looking for pretty properties with luxury finishes. He was a strategist looking for mathematical inefficiencies and desperation. In 1973, the US market suffered a massive collapse due to oversupply and a credit tightening that left real estate developers gasping for air. It was in this scenario of absolute chaos that Sam perfected his investment philosophy. While banks were foreclosing on mortgages and office buildings sat empty, Sam showed up with offers that seemed insulting, but were the only way out for those about to lose everything. The key to his success was not simply buying cheap, but understanding replacement cost. Sam reasoned that if he could buy an existing building for 50 cents on the dollar when building a new one would cost a full dollar, the risk was practically non-existent in the long term. He knew that demand would eventually return, and when it did, no one could compete with his prices because his acquisition costs were ridiculously low. This mindset of looking at the financial fundamentals before the building's aesthetics is what allowed him to accumulate billions while the rest of the industry sank into pessimism. Sam Zell is the ultimate example that wealth is not created by following the crowd, but by having the courage to bet against it when fear is widespread. What I am about to show you is not a history lesson. It is an operations manual for understanding why crises are, in reality, the greatest wealth transfers in history and how great fortunes shield themselves before disaster strikes. The psychology of the grave dancer. The nickname grave dancer was not something Sam Zell rejected. In fact, he wore it with pride because it represented his ability to find value where others only saw financial death. For Sam, a recession was not a tragedy, it was a massive liquidation sale. His approach was based on the law of supply and demand in an almost primitive way. He understood that markets are cyclical and that excessive optimism always leads to overbuilding. When that cycle breaks, the pendulum swings to the other extreme: excessive fear. In the 1990s, when the real estate investment trust market was in its infancy, Sam Zell saw an opportunity to institutionalize property ownership. He did not just want to own buildings, he wanted to create cash flow machines that were liquid and transparent. He built empires like equity office properties and equity residential, applying the same logic of buying assets at a discount and managing them with military efficiency. His goal was always recurring cash flow, not quick speculation. This distinction is fundamental to understanding why his companies survived multiple collapses while the speculators of the moment disappeared. The Great Equity Office Deal. One of the most defining moments in Sam Zell's career was the sale of equity office properties in 2007, right before the global financial crisis devastated the world. Sam sensed that the market was reaching levels of euphoria that made no mathematical sense. Property prices were becoming completely disconnected from the rents they generated. Instead of getting carried away by greed and continuing to buy, Sam made the radical decision to sell his entire office empire for $39 billion to Blackstone. It was the largest commercial real estate sale in history at that time. Many thought Sam was retiring too early, that there was still money left on the table, but Sam knew his golden rule. It is better to exit a year early than a minute late. Months later, the market collapsed, Lehman Brothers fell, and the value of offices plummeted. Sam Zell had not only protected his capital, but had walked away with a mountain of cash, while his competitors were left with buildings they could not afford. This ability to read the end of the party is what separates billionaires from mere lucky investors. The discipline of fundamentals over emotion. To replicate Sam Zell's success, you must first remove emotion from your financial decisions. He never fell in love with a building or a location. He fell in love with the numbers. If the dividend yield and free cash flow did not justify the risk, Sam simply walked away. He used to say that most real estate investors suffer from pathological optimism that blinds them to real risks. Sam's strategy was based on cynical realism. assume things will go wrong, and structure the deal so that even in the worst-case scenario, you do not lose money. This discipline translates into keeping low levels of leverage when the market is hot and having liquidity available when the market cools down. Zell always kept credit lines open and cash ready to act within 48 hours. When the crash comes, cash is absolute king because it allows you to dictate the terms of the purchase. If you have to ask the bank for permission in the middle of a crisis, you have already missed the opportunity. Sam was the bank, and that gave him bargaining power that no one could match. The value of strategic contrarianism. Being a contrarian investor does not simply mean doing the opposite of everyone else out of rebellion. It means having a data-driven thesis that contradicts the popular consensus. Zell bought apartments when everyone said people would prefer to own their own homes. He bought manufactured home parks when everyone said it was a low-class investment. He looked for niches where there was little competition and high barriers to entry. His investment in mobile home parks, for example, was one of the most profitable of his career because he understood it was a land leasing business with almost zero customer turnover. While others fought for the trophy property on Fifth Avenue, Zell was buying land in secondary markets with favorable demographics. He understood that wealth is not necessarily built in the most prestigious locations, but in places where cash flow is more stable and taxes are lower. This strategic humility allowed him to build a diversified asset base that was resilient to local economic fluctuations. Zell used to say that every investment must have a clear exit strategy from day one. He did not buy to hold forever. He bought to maximize value and exit when the risk of holding exceeded the potential benefit. This constant liquidity mindset is what allowed him to navigate 5 decades of economic cycles without being annihilated. He understood that capital is a tool that must rotate to where it is most productive at each point in the cycle. If you are trapped in an investment that generates no cash flow just because you expect the price to go up in the future, you are making the mistake that Zell avoided his entire life. Hope is not a financial strategy. Risk control and insisting on tangible returns are the pillars of lasting wealth. Zell built billions not by predicting the future, but by being prepared for any version of the future that might arrive. If Zell's vision has inspired you to look for opportunities where others only see crisis, subscribe, like, and comment if you are ready to be the next grave dancer in your local market. See you in the next video.